Hello guys, this is the two classes together in production planning. I'm going to revise what we did on Friday's class, and I am going to talk a little bit what I planned to do today. So production planning 5.5. First of all, the basics, introduction to supply chain. Know what the supply chain is. Supply chain refers to the stages of the production through which a product passes from the extraction of raw materials to delivery of finished products or services to the final customer. So I think if you're looking at where to study this, it's very basic in your textbook. In your textbook, they talk about the logistics, the hardware of the supply chain, so basically the trucks that are traveling, and then they also talk about the software, so the information and communication, very important on the modern supply chain as well. But understand, raw materials go into suppliers. This is transferred then into a manufacturing plant, and this is distributed to customers and so on. There might be wholesalers or in between that. Just understand a value chain. It's also a very simple example in your cognitive. This is the one in the cognitive, just basically the wood being manufactured and then being put into parts and then being put into the furniture store. Supply chain management then is the process of working with all your suppliers to maximize the efficiency and deliver the maximum possible value to the final consumer. So remember, business is all about value. If you derive value, if you can add value in something, someone's going to pay you for this value. So your supply chain, it's about being very efficient on it and having no waste and making sure what you do gives the maximum amount of value to the final consumer. So supply chain managers will consider many different factors when selecting suppliers. So this is very kind of intuitive here, but when you're selecting suppliers, what do you look at? You look at cost. So basically, you'll go for something that's cheaper, other things being equal. So you prefer lower cost. It might be there might be economies of scale that exist. It might be by purchasing more from a particular supplier, you might get a lower price. But cost is a big factor for a lot of industries on what determines a part of your supply chain. Reliability, just as important. You don't want a supplier that's going to let you down, especially if you're operating, say, in a just-in-time process. So reliable. You need reliable supplies coming in all the time. Product quality, you don't want to have to be sending products back. You want to be able to set an agreed standard, and the supplier is also linked with reliability. The supplier then is able to provide these. And then lead times. This is important too. You don't want to have long waits, particularly if you have a very expensive end product that requires lots of different pieces. So this might be, if you think about this, think about a company in the US. On cost, maybe it's a lot cheaper to go get from China, but on lead times, it's a lot cheaper to shop locally. This is the trade-off. So other things equal, most companies seem to be favoring cost over lead time, but it is still something important to consider. Just in time versus just in case. I think you guys are all familiar with this. Just in time stock control, smaller regular orders for resources which are delivered just in time for them to be used. Key advantages: reduces cost, improves profitability. Link this back to your finance, okay? So where would this show up in your finance? Just in case then is a bit more risk averse. So what do I mean by that? Just in case you will hold large levels of buffer stock so the business can continue to operate when faced with an unforeseen event. So something like the pandemic. So there's a lot of studies and a lot of talk going out now about companies might be moving away from just in time and towards just in case, because even though it's more costly, even it allows companies to react to an unexpected bottleneck in the supply chain. So if you had just in case during the coronavirus, you might have been all right for a lot longer than the companies that were just pure just in time. You should have done this already, but go have a look, read about Zara. Remember, guys, scoring 6s and 7s in IB is about examples. Go and have a look, take about 2 or 3 key points on this. Then I also shared these 2 videos as well. I mean, just basically looking at the impact of the globalization and the pandemic on the supply chain. So, I mean, it'd be crazy if we didn't get any question related to the pandemic on the exam, you know, how it changes, you know, the office and so on. So it's going to change from a HR perspective, it'll change the office, but it's also going to change production. Will more companies shift away from China? Will China have to change how they do business, and so on? So some of these things are mentioned in these videos. Just watch them. They're very short, 4 or 5 minutes, 3 key points from each. And always, whenever you're getting points on something, think about your stakeholders. Also, you know, they also talk about e-commerce just in time here. Think about who's impacted by these businesses, society, which countries, and so on. Ask yourself, are companies going to move out of China? If so, who will benefit? Perhaps they're not. I think maybe China just needs to offer something different, and that other countries that are lower cost do the dirty work. Reminder, just in case, just in time, you know, don't go into an exam not knowing what these are. Just in case, traditional method of stock control, which means holding reserve of both raw material and finished product in case of a sudden increase in demand. So a very cautious, very risk-averse approach would have served you well during the pandemic. Just in time is the modern, so I just took this from your textbook, a modern method. So your textbook's a bit dated, but just in time is relatively modern way. It's just saying, hold on, we don't need to spend a lot of money having lots of stock, just get it when we need it. And we can, if we run an efficient supply chain, if we have good data management and so on, and we know our customers well, we know our demand well, etc., this is going to work and save us a hell of a lot of money. You guys, you need to know the main differences between them. A really good summary of the main differences. Go to table 5.51 on page 376. You'll see some of the differences, you know, just in time reduced costs. Just in case might also reduce costs because you're buying in bulk perhaps, but maybe the cost of storing it is a bit more. Yeah, so have a look at that table and then come back to me if you have any questions on that. And then when you're always doing this, think about which of these is most appropriate. Think about the benefits, think about the costs, etc. Next, stock control chart. What the hell is this? Well, this stock control chart here, I've taken this one from your Cognigy. So you can see this under section 5.5.3. Essentially, be able to explain each of these different things here. So this is your stock control chart. So on this axis here, you have your stock level, the number of candy bars you have in stock. And you can see at the start, you always start with 600. And you know that after 4 weeks, it'll be down to 100. For some reason, you've decided that 100 is your minimum stock level. You're not going to go and eat 100 because you just don't want to run out. Maybe you get people asking for your for more stock. You've also said that you're going to have named 300 as your reorder level. So the minute your stock hits down to 300, you're going to reorder more stock. And what is your order quantity? Your order quantity is, you know, that if you order 300 at this time, you know that the lead time, the amount of time it takes you to get your new stock, this time, by the time this comes, you'll be down to 100, and you're going to have maximum 600, so you order 500 here. Okay. And that is your stock control. So basically 100, another name for this 100, your minimum stock level is just your buffer stock. It's the amount of stock you always, the minimum amount of stock you're going to have of this product. So you're going to have, so this company has decided at the minimum they'll have 100 bars of candy. At the maximum they'll have 600. They know this is a very simple process. They know that they basically run down and do these calculations 125 a week. So they go from 600 to 100 within 4 weeks. If they know they're going to go down at this level here, when they get to 300, that's when they reorder, because they know this is how long it takes to get the stock in. And they reorder 500 because they know by the time they get down to 100, or sorry, the time they get the new stock, they'll be down to 100, and then they need to get back up to 600. So know how to do these stock control charts. Just be able to follow it. There's a good example on the numbers on page 378 of your textbook. There should be some good practice questions on the Cognidy as well. So what determines the optimal stock level? So if you look, so when companies are thinking, how much stock should we keep? What determines this? Well, many different factors. And when you're here with a 6, if you're in an exam setting, you don't need to explain 6, pick about 2 or 3. And it's good to have an overview of all these here, because depending on the case study or the question you guys are given, maybe some of these are more relevant than others. So the first one we'll look at is the market. Is it growing? Is the business increasing scales? Are there new competitors coming into the market? Is the market likely to shrink? If the market is growing fast and you're selling lots of this good, or it's a really fast growing market, this is going to be something pushing you towards holding a lot of stock. If the market for your product is shrinking and there's lots of competitors and more competitors coming in, then you're going to be pushed towards holding very little stock. The final product. So what type of product is it? Is it does the production depend on many suppliers? Is it a cheap single-use product? These things will help play a role as well. So if it's a cheap single-use product, you might have lots of it. If it's a very expensive product, uses up a lot of your working capital, your cash flow, you might have very little. The stock itself is important. Is the stock perishable? I mean, is it something that can go out of date really quickly? Will it take up a lot of storage space? This also plays a role in how much stock you should keep of it. The infrastructure is also relevant. You remember in the previous page we talked about lead time. Is there a long lead time in getting the stock? Is your supply chain reliable? Or do you have good roads, good rail, good shipping networks, etc.? If so, you might be inclined to keep less stock. Up here, then we have finance. So basically on finance, this is about your financial situation. If your company has a lot of cash reserves or strong working capital, you can afford to keep more stock. And then the other one here is on HR implications. What are the implications for resourcing changes in stock holdings? So what if do you need to hire more people to work in the warehouse, for example? Is it hard to get the right people? That might be something you take into consideration. The last section in your textbook and in Cognidy is it's 5.4 and 5.5 in the Cognidy. It's from pages 379 to 381 in your textbook. So you may have to calculate these things here. They're quite straightforward, and you'll get questions in the Cognidy on them, and you can also we'll just quickly go through in the definitions too. I mean, one of them, your unit cost, your average cost. Essentially, it's just your total cost divided by the amount of units you produce. Your productivity rate. What's more important about the productivity rate? I mean, calculating is very straightforward. Productivity is just your total output divided by your total input, and then multiplied by 100 to put in percentage. Or sorry, to put in units of production. So productivity total output divided by total input, and multiply by 100 to put into units of production. So why do we care about productivity? Well, I mean, it's basically saying how much does each worker produce? So higher productivity is better. So the type of questions you might be asked on this is, well, how do you improve labor productivity? What can you do? Well, I mean, go back to your HR. Improve training, improve motivation, better management techniques, better use of technology. All these things will improve your productivity. Here then, the next one, and we did something like capacity utilization when we were looking at the decision tree last year. Capacity utilization. Well, what does that mean? It's essentially the percentage of the firm's total capacity that they're using, that they're currently using. Why is this important? Well, if a firm is using very, you don't want to be using too low your capacity, and you just have far too big a factory. If it's a really low capacity utilization, you're not using all your resources. But if your capacity utilization is getting very, very high, if it's really, really close to 100%, the risk then is that maybe you're pushing your equipment, you're pushing your resources too hard, and you might have a breakdown, for example. So understand the definition of capacity utilization: actual output divided by productive capacity multiplied by 100, and it's in a percentage. And these last two, cost to buy, cost to make, this is just covered on page 381. And essentially, the example they give on 381 is you have like an international school that's looking about whether it should buy the bus itself, or it should do it should buy the bus itself, or buy a service for the bus for transport, or it should take it on itself. So have a look at that one there, and then we'll talk about it briefly at the start of the next class. Okay, so, and also make sure to work on your assignments. See you guys on Thursday, apart from those who are in the class.